Hi, my name is Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about preparing for a recession. And I'm not saying that there is a recession coming or we're in one. A lot of people think we're maybe in one or almost in one. And when you look at your portfolio, you might think, yeah, we definitely are, Adam. Like my portfolio is down 10, 15, 20% plus, and it's starting to hurt. And I want to deviate from my plan, and I really don't know what to do. And a lot of you turn to panic. And panic is the worst thing to do in times like this. I know a lot of our viewers are close to or in retirement. This is for you guys. Now, if you're younger, for sure, you need to stay with the plan as well. And you can take all three of these points away. But definitely, 45 plus, getting close to retirement or in retirement, this video is for you because making a bad decision closer to or in retirement can really affect your financial and retirement plan. And a lot of people come to us, in 2020, we had a lot of clients come to us because they blew their plan up and they came to us to try and stitch it back together. And my goal with this video is to make sure that you don't blow it up. Before I jump into it, if you haven't already subscribed to the channel, hit the subscribe button. I know a lot of you watch me on TV and maybe you're not logged into your YouTube account. Log in, hit subscribe, hit the notification bell, and you'll get a notification every time we release a new video, which right now it's 3 times every single week. And of course, if you enjoy these videos and they help you, hit the thumbs up button. It does help get these videos out to more people. And as we all know, more people need to hear this content. So as you prepare for a recession or a market correction, as you are in retirement or close to retirement, there's 3 key things you need to focus on. And I want you to go through all 3 and sit down with your spouse, your financial planner, whoever in your world that you kind of run finances with. Because I promise you, having accountability and someone to bounce ideas off of, someone with a sound knowledge. And I've talked about this a lot on the channel. Sometimes we come alongside someone in our financial journey, and that person is more of a mess than you are. And what it does is it pulls you in their direction, and they have the off ramp that's going nowhere. And you need to make sure you stay on the highway and pull them over and make sure that you guys are working together and holding each other accountable. So the first thing you need to do is clarify your income plan. And that is either pre-retirement or post-retirement. If you're not quite retired and you're building up that financial retirement plan and looking at how much your savings and whatever, your account may have dipped from 300,000 to 250,000. And in your head, you're thinking, oh man, I either have to work longer, I'm gonna have less in retirement. We think very short term. If you're in retirement, you need to understand what your cash flow plan looks like and why that's important. And I always say this, when we put a plan together, I can show you, here's how much money you need to take out from each account for the next year, 2 years, 3 years. Some people like to take that and just move it to cash so that they know that cash is there. Some are invested in dividends, so some of their cash flows come in through dividends. Some, they're selling stock or bond or whatever it is. There's different ways to actually get the cash in your pocket, the income in your pocket. But the important part is to know how much income you need. I think a lot of us, especially if you're not in retirement and you're getting near retirement, you're thinking, when I hit retirement, I need my money. And this market correction is blowing things up and I need to cash out and go to a GIC. The reality is that you're probably going to need between 7 and 12% of your portfolio on an annual basis. Now, that's a lot. You may need less than that, but it is a big number, but it's only 10%. If you wanted to carve out 10 or 15 or 20%, so you had a couple of years of cash flow, then that's a great way to do it. Again, there's no right way to do it. The right way, though, as far as understanding, is make sure you know how much you need. Before I go any further, if you find I'm talking funny, it's harder to hear me, I just had oral surgery. I'm going to cover that in this next video and go through why I went through oral surgery and some things I'm going through right now. But I'm all kind of numb up in here and swollen and whatever. So I apologize. Hopefully you guys can hear me okay. But go through your financial plan. If you don't have a retirement plan, something that shows you how to optimize income, minimize tax, where your money's coming from, how much there is for you, how long it lasts, feel free to reach out to our office or talk to your financial advisor. Get that plan in place. When you look at a cash flow plan, you can see here in the middle RSPs. So we know that this year the client needs $30,000 from their RSP, and they need that for about, 5, 6 more years. If we look at that, then it's going to drop to $20,000. But I can tell this client, look, client, you need $30,000 this year next. How are we going to get that? And, it might be a combination of dividends, how their portfolio, maturing bonds. There could be a multitude of things. But we know that $270,000 of their portfolio they don't need. And we also know that 240,000 they don't need for 2 years. And what does that do? It gives you time to let the markets come back up. Look, if you're watching this video, I can almost guarantee you that you went through 2020 in the markets. You probably went through 2018, 2011, 2015, I missed there, 2008, the tech crash. You've been through this many, many, many times. Yet, every time we come up against it, you start to panic. And rightfully so, especially as you enter into retirement. It hurts more, it's more real when these market corrections happen because they impact you more, right? You're starting to draw money out. So not only does your account go from 300 to 250, but you're drawing 30,000 out. And that starts to hurt. You start to see it, it's painful. And what you start doing, you start deviating from the plan. No, I'm only gonna take out 15,000 this year. I'm not gonna travel, I'm not gonna do this. This is where it's important to have a plan and then don't deviate from that. We know the market's gonna go like this over time, but it will go up over time. Historically, it's gone up over time. We're going to assume it's going to continue to go up over time going forward. The second thing you need to look at is cash flow, not cash, cash flow. Cash flow is king. In retirement, cash flow is king. This is why I'm a big proponent of dividend paying stocks. And I'm not saying you have to invest in dividend paying stocks. This is why I like it. When I put a plan together for a client and they have, a 3, 4, 5% dividend yield coming in from blue chip quality companies, I know that the company that they're invested in is safe and solid. It's not going anywhere. And 4% is being paid to them in the form of a dividend. So if their cash flow need is say 7 or 8%, they're getting half of that through dividends. So there's less cash or less stock or bonds or equity we need to sell to meet their cash flow need. If you took your $300,000 portfolio and took a step back and said, look, if I don't touch it in the year, how much cash does it generate for me without having to sell anything? And if the answer is 0, you may want to revisit your investment approach heading into retirement. If it's a lot, I know a lot of you follow passive investing and your cash flow might be 12 or 15%. If the market corrects, is there risk there? I haven't done the research on how that investment stuff works. I'm not into that, but I know a lot of you are, right? You're getting that high yield investment, which is great. It provides that cash flow. Cash flow is king. But what's the underlying stock? How is that managed? If you're investing in that, don't just follow someone's advice. And Adriano's a great guy. I love his videos, watch him all the time. But do your own homework too. Understand, Adriano's younger. If you're in retirement and one of those leverage plays blows up somehow, again, I don't know how these work, but do your homework. Understand, what is the risk there? But again, cash flow, cash flow, cash flow. You want to generate cash flow to your account because then you're not worrying about, oh, my account's down. I got to sell stuff to generate income, to live retirement, to do travel, and just do everything you want to do. The third and final thing is don't be short-sighted. And this thing drives me bonkers. And a lot of you fall into this. I had an email yesterday from a client saying, please sell, I'm going to a GIC. She's in retirement, that's her prerogative. I get it. Look, I completely get it. You see your account, again, it's gone from 300 to 250. Maybe it's gone from $1 million to 800,000. Maybe it's gone from 100 to 50 or 80 or whatever it is. It's probably come down in value. If your account hasn't come down in value, good on you. Something's going well. You're in a market that no one else is in. When you see your portfolio drop, especially when you're in retirement, it's troublesome. I get it. We see it with clients all the time. The thing is you need to A, plan for that, and B, understand we're going to go through this again and again. And you can't panic and become short-sighted and say, oh, look, I'm down 5% this year. I'm just going to go buy that GIC for the next year at 3.5. At least I'm not losing money. Well, the reality is that you're locking in that 5% loss. You're only going to get 3.5. So it's going to take 1.5 years up to 2 years to get your money back. Plus, how does that change your plan? Maybe your plan is built on an average 5% rate of return, and now you're locking in money at 3.5. So not only is it costing you short term, it's going to cost you long term. Now, is that person pulling out, saving themselves from another 10 or 20% drop? Possibly. We don't know. Right? You don't know if the market's going to go up or down tomorrow. Today, as I record this, we're down. Yesterday was up. I'm sure tomorrow will be up again. Who knows? If you become short-sighted, it will cost you retirement. And maybe you can afford it. Maybe you say, look, Adam, I'm rerunning the numbers at 3%. I'm buying GICs. I still have enough money. I'm happy I can sleep at night. Perfect. That's your plan. You've now changed your plan, but it meets your retirement needs. That's totally fine. But a lot of you start to deviate from your plan, and it's costing you the retirement that you worked for, that you hope for, because you're short-sighted and you can't see past the markets of today and tomorrow. But look at the past charts of when we've seen a market drop. What happened shortly after? The market comes back up. Sure, it might take months, years, but where are we? We're higher than we were in 2008, 2011, 2015, 2018, 2020. I don't have the crystal ball. I just look at historical data or historical performance, what our clients have been through in the past, what you guys have been through in the past, and say, chances are we're going to get through this. We're going to be higher on the other side. And those that wait it out, that follow these 3 steps, are going to be much better off. Again, this client here, $30,000 this year, $30,000 next year. There's a $60,000 cash flow need here. If you're the type that says, if the market drops, I'm pulling 20 because I'm panicking, take $60,000, take 2 years of what your income need is out of your retirement accounts and move it to cash, high interest savings, GIC, whatever it is. You can leave it in the RSP, obviously. You need to do that for tax purposes, but de-risk. And then look, I can have a 2-year recession and it's not affecting my cash flow, my portfolio. I know the portfolio is going to come back. I took my 60 out. My 240 might go to 140, but it's going to come back. History says it will come back, and I have my cash flow ready for the next 3 years. But again, don't let this short-term blip change the next 30 years of your retirement. If you have 30 years of retirement, you're going to go through this maybe 8-10 times in retirement. Are you going to stress yourself out every time? If you are, you need to find a strategy where you can kind of work around this. Don't stress yourself out. Relax a bit. Retirement should be an enjoyable experience. Don't let market corrections ruin and destroy your retirement. So thank you for joining us in this video. Sorry again about the language here. I'm going to release a video in a couple days from now. Talks all about this, a bit of a cancer scare, so I'll have that story in the next video. So thank you for joining us in this one. We'll see you in the next one.